On the Express this week, more record highs for stocks. This is the overbought rally. The Fed faces its most important decision, maybe ever. Claudia Sahm, the economist, drops in for a few good minutes to help us straighten that out. The corporate breakup is the new it thing, the Investopedia indicator, and what to watch this week. The smoothest ride to success rides along the Investopedia Express. Welcome back and welcome aboard. Good to be back in corporate headquarters here. Been on the road for a few. Nice to be back with you folks from around the world. Thanks to all of our viewers watching us live from all parts of the planet. I know we got India in the house as usual. Canada's probably in the house. Good to be with you. Good to be back again. Join the conversation. Chime on in. We'd love to hear your comments. We'd love to hear from you wherever you are. The smartest investors in the world. Listen and watch the Investopedia Express. Welcome back to the show, and we are back at record highs. NASDAQ and the S&P 500 hitting new record highs to close out last week. Let me get a little air horn. Oh, yeah. Love me some air horn there. Record highs, pretty much when you look across the sectors here, lots of strength, mostly in the big sectors that have been driving the market forward, but also pretty big mojo, as we say. Do your best, Jim Morrison, and get your mojo rising because we have momentum indicators, moving averages. There he is, the great Jim Morrison. Get your mojo rising because we have momentum indicators in the green across the boards. The technical analysts like to look at moving averages, right? They look to look at moving average to look at strength in sectors. And when you look at the moving averages, they are all in the green. The S&P 500, the NASDAQ composite, the NYSE composite, the Russell 3000, the Dow Jones Industrials, and the Russell 2000. That's basically your stock market right there, minus the micro caps, and they are all headed in the right direction. That's what we call momentum there. When they're surpassing their 5-day moving averages, their 50-day moving averages, their 200-day moving averages, you know charts are moving up and to the right, and that's what we've been seeing lately. And why is everyone so bullish? Well, they know what's coming their way, and that, my friends, is lower interest rates. We got a massive Fed meeting this week and a big decision on interest rates. We're going to get into that with Claudia Sahm, but look at this great chart from our buddy Charlie Bilello, Creative Planning. This is the market expectations for the Fed's funds rate over the next year. Go to where we are right now, 4.25%, maybe a quarter point cut this week, a couple more cuts by the end of the year. By the end of next year, the end of 2026, you could be looking at a Fed funds rate below 3%. And that will have a profound impact on the economy and on people's savings, but also on the stock market. Everyone's been waiting for the Fed to cut rates. They haven't cut rates since December of 2024. This could be the beginning of a rate cutting cycle that makes money a lot cheaper for a long time. But what has that turned into? Overbuyers. When you look at the stock market, we are overbuying like it's 1999 or 2021 all over again. Great chart here from our friends at Bespoke Investments. We've gone from extreme oversold to extreme overbought in just a few months. Just look at the past year. We've had these extremes in overbuying and overselling, and that's just our animal spirit talking to us as investors. You know, we're greedy. We're over greedy sometimes. We're too fearful sometimes. That's just us and the amygdala part of our brain making us react to conditions in the stock market. And there have been plenty of reasons to be fearful this year, and there have been plenty of reasons to be optimistic. But when you just look at the scatter plot of where we've been, where our emotions have been, we've gone from extreme overbought to extreme oversold multiple times this year. And that's probably going to continue. Volatility is the name of the game right now, but everyone's buying. When everyone's buying, you know things could go the other way pretty quickly here. I'm not saying it's a total contrarian indicator. Right now, it's been up and to the right. Just look at where we've been. That's just a good chart of our emotions that is represented by overbought and oversold conditions by Bespoke Investments there. That's where we're at. We just can't keep it mellow. But if you've done the right thing, if you've played the game right, if you've been a smart long-term investor, then you have been handsomely rewarded. Charlie Bilello again with a great chart on returns, total returns for the past decade. How about that, right? How about plus 14%, 14.9% total return? That is your returns from the stock market plus reinvested dividends. I don't know if we'll ever see a period like this again. 14.9% per year. You're welcome. If all you did was put $10,000 in the stock market and got cast away like Chuck Noland in the movie Castaway, put 10 grand in the S&P 500, went away for 10 years and started yelling at a volleyball, that'd be worth more than $40,000 today. How to quadruple your money? Invest for the long term. And this period we've just been through, the past decade, has been sensational for investors. So you could be a castaway like Chuck, put your money in the market, go away for 10 years, or you could do the right thing and keep dollar cost averaging in, maxing out your retirement investing accounts. It's been a great time to be an investor. I don't know if we'll see an era like this again. If you haven't been invested in the past 10 years, you've missed out on some incredible returns. So, congratulations to you, long term investors that have been playing the game right. Keep playing the game right. You don't need to let your animal spirits rule you, get overbought or oversold. Play the game right. Be a steady long term investor because the rewards are pretty handsome if you just do the right thing. All right. As I said, we got a massive Fed meeting this week. All eyes on the Federal Reserve, not just on the decision from the FOMC, but on the drama going on inside the Federal Reserve and the Fed's independence really at stake here. So let's bring in Claudia Sahm. She's going to drop in for a few good minutes to talk about the central bank and its future. Claudia, it's so good to have you back. She's the chief economist at New Century Advisors. She's also got the terrific Substack, Stay at Home Macro, which I'm totally addicted to. Great to have you back on the Express. Thanks for joining us.
Great. Happy to be here. Thanks.
Um, what's at stake besides the path of interest rates? I think the market is fully baked in, and investors have pretty much come to the conclusion that we'll get a quarter point cut here, maybe a couple more before the end of the year. But this is a much bigger Fed meeting and a much more dramatic environment around the Fed right now. Give us your take.
Yeah, so the stakes are very high. I mean, first, just the reality, the economics of it right now. This is the hardest moment for the Fed, for a central bank, in that the Fed's dual mandate is in conflict. So inflation is above the Fed's 2% target. It's been above 2% for multiple years now. We're in a lot better place than we were, say, in 2022, but that's still not back to target. So inflation is still a problem. And we've seen the labor market really slow down, with the potential that we could have a real deterioration in labor market conditions. So that's the other side of the mandate. So whenever the Fed has the two sides of its mandate in conflict, like, it has one tool, right? So you can't both cut and raise interest rates. Like, you can't address both sides of it. So they have to really look through the data, think about the risk, think about the outlook, and then come to a decision, communicate it, right? It is important. Even if they begin a cutting cycle, they are concerned about employment. They do need to signal that they are committed to still getting inflation to 2%, right? So it's a very tricky, like, everything would have been hard about this week regardless. And then you add on top of it all of the potential political influence. I mean, this is one meeting where it might actually be more important who shows up to vote than how the vote comes out,
Right. We
right?
don't
And
know if Lisa Cook, the Fed governor who the president allegedly fired, or fired allegedly because she had a second, didn't declare a second property not true, is going to get to vote, or Stephan Miran, who the president appointed from the Council of Economic Advisors to the Fed, will get to vote, or what the dissension looks like inside. The Fed's usually not a dramatic place. Right now, this is Shakespeare happening right there in Washington, D.C. That's got a profound impact on global finance.
Absolutely, because the Fed, as we know it, as we've come to know it in recent decades, it's really on the line right now. So there's been a lot of discussion about Fed Governor Lisa Cook, and frankly, the case that's been brought against her, or the president trying to remove her. It's really not about her. It's about President Trump wants ultra low interest rates. He has been very clear about that, and frankly, it's not that big of a problem if he just says it over and over again and is really angry the Fed doesn't do what he wants to do. Most presidents say that in private and not in public, but it was when it crossed the line to actually trying to remove Fed governors, put in place people who were loyal to him. then that's going in the direction of a Fed that basically does what the president tells them to do. And if the president is successful in removing Lisa Cook, and the argument the government is making is that the president can determine what is for cause without judicial review, if he is granted that power, then basically the entire Fed governors, they're all at will. They could
Yeah.
all go. And so then you really have a president in charge of the Fed, and that's not, uh I mean, history tells us that is not a good setup.
Yeah, we're
in
looking at charts
terms
here
of
from the University of Chicago Booth School survey about whether Fed independence would substantially, or the loss of Fed independence would substantially increase the overall nominal cost of U.S. government borrowing. Translation: if the Fed isn't independent, are investors who buy our bonds going to demand more premium because all of a sudden we look riskier because all of a sudden the central bank is under the executive branch control and they can do what they want with it. They may have ulterior motives than price stability and maintaining maximum employment. Is that why we're seeing that reaction?
Yeah, and I would say, in terms of politicians being in control of a central bank, the probably most likely outcome is we end up seeing a lot more inflation and a lot more instability, right? Like these are not standard business as usual. Now, I will warn: it is true that the federal funds rate is a very short-term interest rate, and so we talk about longer-term rates, 10-year Treasury, 30-year mortgage, like that's they move some with the Fed funds rate, but not like there are lots of other things going on with long-term interest rates. But I would remind everyone that the Fed has more tools, and we have had periods in history where the Fed held down not just the short end, but also the long end of the treasury curve. So it wreaks a lot of havoc. And again, I think, those are situations where you can end up with a lot of inflation. The last time that the Fed had that kind of coordination with the White House was during World War II, with the express intent of, helping fund the war efforts. And in the early 1950s, the Fed said no more because it comes at a cost with higher inflation. But we just, once you can't, like, once the Fed loses control of itself, like, there's a lot of things that could happen. Not saying they're guaranteed to happen, but it just the way we think about the Fed, we think about their tools, um, uh, you know, all bets are off
Yeah, if you're
in terms
looking
of
for
what comes
countries where
next.
the Fed doesn't have independence, look at China, look at Turkey. It gets very interesting over there. I'm sure you saw the letter Treasury Secretary Scott Bessent sent to the Wall Street Journal on Friday, pretty much criticizing the Fed, saying it hasn't been flexible enough in some cases. In some cases, it's expanded beyond its mandate. It's hurt its credibility. Its credibility is threatened. We know Kevin Warsh, former Fed governor, would like to see Treasury and the Fed get a little bit closer together. Harry Truman tried to do this, to your point, in the 1950s until they set up that accord that actually separated the Treasury and the Federal Reserve officially, even though it was written that way. What's your reaction to the Treasury Secretary's letter? Has the Fed overstepped its bounds? You work at the Federal Reserve as an economist, as a labor economist there, but do you think through quantitative easing, through the backing or the bailing out of banks, through TARP, through all the different measures the Fed's had to take over the past 20 years of various crises, that it is indeed overstepped?
So Secretary Bessent's opinion piece lacked some fundamental context. I thought, it is true, the tools, the asset purchases, the quantitative easing, that was not a tool that the Fed had used for some time, and that exactly is one of those tools that can get the longer end interest rates down, right? So, but in 2008, the federal funds rate during the global financial crisis went to zero. And the economy was still in a bad place. It still was too weak. We needed to have more support to it. And so the Fed looked around at what other tools do we have to influence interest rates? And they chose asset purchases. They chose the quantitative easing. So it's not like Ben Bernanke woke up one day and is like, yeah, I want to go buy me some treasuries and some mortgage backed securities, right? Like it was trying to solve a problem. So I am completely open to having a discussion of, there were some side effects to the quantitative easing, and it does start blurring the lines between monetary and fiscal policy. I mean, that those programs in essence monetized a portion of the US federal debt. I mean, that so it Besant is correct in that that's something different than the federal funds rate. And you know, but like the context of why did we go down this path? And if you don't like those tools, what other tools would you suggest? Otherwise, those kinds of critiques of the Fed to me aren't about making the Fed better. They're about diminishing the credibility of the Fed as it is right now, weakening it, and then you take advantage of it and change it. I would argue, I think this case that the Fed has lost its credibility is a pretty weak one. There's been a lot of critiques of the Fed, and I think Ed Powell has also agreed with these that they were a little slow to start raising interest rates after the pandemic surge in inflation. So probably should have got going in 2021. We still would have had inflation. The world all had inflation from the pandemic, but they could have moved faster. And a lot of people point to that as, the Fed was behind the curve and this is a problem. They lost credibility. But, like, we don't talk enough about the fact that we had essentially a soft landing. Starting in 2020, well, actually in 2022, but particularly in 2023, inflation really came down. Inflation expectations in markets and also in surveys largely stayed the course, like the Fed will get inflation down. We didn't have to have a recession. That was extremely unusual. So, and I think there are people who make an argument, I think a good argument, that part of that was that the Fed as an institution had credibility as an inflation fighter. Like, you don't want to be cavalier about it because, again, the longer we have higher inflation, you might chip away at that. But the idea that the Fed isn't credible, I just don't see it. I mean, markets hang on every word coming out of the Fed. Like, they
Absolutely.
clearly think
Where would
something
we
is.
be? Where would we be without some of those bailouts, without some of those extraordinary measures? It's hard to know, but remember that was Ben Bernanke
Mhm,
and his team at the Fed years ago. But
mhm,
everyone points the finger, especially the president and Chair Powell. It is a board of governors, right? It is an FOMC, and it is a central bank that is also made up of other central banks from around the
mhm.
country. So let's go out on this. You worked at the Fed as an economist. You know well. You study it well. What does the Fed and what does central banks do? What happens among those regional banks that if it went away tomorrow through the loss of independence or through some cut from the administration, if it went away, besides the things that are very obvious to us, which is setting the Fed, the interest, the borrowing rates between banks, what would we miss? How would we feel it as ordinary citizens and potentially as investors? What's the one thing that's happening inside that we just don't know about?
So, the the Federal Reserve System, I mean, it's not a perfect setup, and it's pretty complicated how all the pieces fit together. I do think there's a real benefit from the fact that we have the regional banks. So there are 12 banks across the country that feed into and a portion of their president's vote every time the Federal Open Market Committee meets. And one of the things that they do is it is a very effective way to bring in perspectives from across the country. The Fed is not just an institution sitting in Washington, D.C., staring at numbers and like making pronouncements about interest rates. The Reserve Bank presidents, the staff at the Reserve Banks, like they are out in the communities. And many of often, there's an aspect of going out running like the Beige Book, which is it's it's a survey, it's like a conversation with community groups and business leaders in the district that then before every one of the FOMC meetings puts together to kind of give a picture of it. And the Reserve Bank presidents are constantly meeting, and they also, I mean, this is maybe a little less publicized, but the Federal Reserve Banks have a convening function. Like they get together different community groups and try to work on different projects and community development. So I think that the fact that the Fed has people out in the country, like trying to understand what's happening across the country, talking to real people, trying to give um, a focus to their voices, I think that is a really important aspect of the system that we have in place. That and as we talked about the Federal Reserve independence under threat, so the governors, I mean, one part of the Fed being under threat is all of the Reserve Bank presidents every 5 years they have a review, and the board in DC goes through the candidates, and it's usually a pretty standard thumbs up, did a good job, here's another 5 years, if the Reserve Banks locally have supported the candidate. And there's concerns that if there's a majority, if the president's able to put a majority of his people in DC, that we may see Reserve Bank presidents get booted out. And I think that's really unfortunate. Like, we need to have those regional perspectives represented in the policy making.
Right. So important. It's not just interest rates, folks, and it's not just these meetings that we all obsess about and the market obsesses with. It is this community reach. That's the whole point of the central bank system, and it is unique to this country. Claudia Sahm, the chief economist for New Century Advisors, and also the terrific Substack Stay at Home Macro. Always appreciate your insights. Thanks so much for joining the
Great.
Express.
Thank you.
All right, let's get into some money in motion. And as I said earlier, momentum is up and to the right. Almost all momentum indicators in the stock market in the green right now, as investors are pretty much betting on higher highs. And you see Wall Street's forecasters and the big institutional investors raising their forecast for the year-end targets for the S&P 500. That we're going to trade higher from here. And when I look at this, I want to look and see if anybody's betting the other way. So I like to look at the put to call ratio, right? The put to call ratio, according to Investopedia, measures through the Chicago Board of Options Exchange the amount of uh, bearish bets, basically puts in the options market, uh, versus the amount of calls. How many people are betting that the market's going to fall over the next 30 days? And that put to call ratio is super low right now. Chart from our good friends at Y Charts here, checking that out. The put to call ratio, again, that chart there, down and to the right, different from the stock market, where the put to call ratio is anywhere below 1.5 or 2. That just means everyone's betting that the stock market's going to keep rising from here. And when everyone's betting the stock market's going to rise from here, you got to wonder who's thinking that it might go the other way. What could go wrong? As long-term investors, we shouldn't get too caught up in the day-to-day trade here, but this is just another indicator of how bullish we are right now. The put to call ratio extremely low, something we're going to keep an eye on in the coming months, and especially after that Fed decision on Wednesday. All right, let's get set up for a very busy week ahead. What's coming on down the tracks this week? All right, we got that big Fed meeting on Wednesday. The Fed meets tomorrow, Tuesday, into Wednesday. Fed decision coming on Tuesday at 2 p.m. Eastern time. But probably the most important part of that is going to be the press conference with Chair Powell. Today, Monday, just the Empire State Manufacturing Survey highlighting the economic reports. How's things going in the great Empire State of New York? Tuesday, big day, U.S. retail sales for the month of August. Did we continue to spend last month, or did tariffs or the threat of tariffs scare us away? We're also going to get the import price index for August as well, and industrial production. We know some softening in the economy going on, but all eyes are on Wednesday. Fed interest rate decision, Fed Chair Powell's press conference at 2 p.m., right to about 2:15 p.m. right after that. Meta Connect 2025. This is the big Facebook Meta conference. We're going to hear remarks from Mark Zuckerberg, the founder and CEO. That stock's been raging lately as they've gotten a little bit closer to the White House. Housing starts for the month of August. Nobody was building too much in the month of August, but as interest rates come down, maybe we'll get a reawakening of the housing market. Thursday, initial jobless claims. Usually we don't focus on them week to week, but they spiked to a multi-year high last week. A lot more people filing for unemployment as the labor market softens. And a good look at the U.S. leading economic indicators for the month of August. Are we headed to a recession or not? Doesn't look like it, but we do have rising unemployment here. And that Sahm rule that Claudia Sahm was known for, if we get 2 to 3 months of rising weekly unemployment claims, usually that leads to a recession, but doesn't look like we're headed towards one right now. Friday, actually a mellow day. Take some deep breaths after a very, very busy week. All right, let's get in to our indicator of the week. And we're going to do a daily double this week. Why? We're just feeling a little frisky. We haven't been back in the office in a while. First one, are we at peak AI? Because if you listened to the earnings calls and the earnings reports over the past quarter here, over the past few weeks, as companies have been reporting their results, we got almost 300 companies using the word AI throughout their earnings calls. So we might be at peak AI where everyone's starting to use it. A couple of years ago, it was blockchain. Everyone liked to say blockchain. A couple of years before that, it was crypto. Before that, it was cannabis. So there's always some catchphrase, and we know AI is the overarching dominant theme right now across the investing landscape and really across every single sector. But when are we going to hit peak AI? When all 500 companies are mentioning it on their earnings calls? Here's another theme we are keeping a very close eye on right now. It's breakup season. I know it seems weird after the summer, but the number of companies that are announcing spinoffs, great chart here by the folks at Charter based on Sherwood News data there. The number of companies spinning out or breaking up is near a decade high. We've already had several announced so far this year as more and more companies are spinning out divisions or entire franchises or the entire halves of their company. We've already had some pretty big announcements so far this year. Keurig Dr. Pepper, they're splitting up after Keurig bought another coffee company. I think they bought Pete's. So they're going pure coffee there, and Dr. Pepper, be a pepper. There's only one Dr. Pepper. They're staying on their own. Warner Brothers Discovery, also talking about a split up of the cable networks and the news networks and some of the other divisions there. Great film library there. They also own CNN, my former employer. There's a lot of talk about what's happening next in the big media industry. So we're going to watch that one pretty closely. Kraft Heinz announcing that split last week. Cream cheese and ketchup going in opposite directions, and Honeywell saying it'll split up into 3 different companies. Now, why is this happening right now? Because there's a lot of corporate activists, there's a lot of investor activists that are pressuring these companies and pressuring their boards of directors and their CEOs to generate much more cash flow, to generate much more velocity, sales velocity, and momentum. And a lot of these other divisions may be slowing them down. As we talked about earlier in several episodes, the most important metric right now in the stock market seems to be revenue per employee. And when you have these big divisions and these slower parts of the company that are not producing as much growth as the others, well, they're just getting uh, cut out and put off to the side or spun out into their other companies. So corporate breakup season in full effect right now. Indianapolis is in the building. What's up, Magnate 1NM? Good to see you again. Hey, I look like Maury. Yeah, we'll say that I look like Maury Povich on a skateboard, maybe. I haven't seen Maury on one of those. Thoughts on moving 6 monthly reporting? Will it be good for stocks if we move to a 6-month reporting season? I'll tell you what, the quarterly reporting season is tough for public companies. That's why we have so many fewer public companies today. Companies have to report results every quarter. They got to spend half the quarter preparing for those results, making sure they deliver on those results, trying to beat expectations. That might be better. You've heard a lot of CEOs complain about it. It is onerous. But as investors, we want as much information as possible. So I want to make sure I was getting access to the information I needed if I'm not going to have a quarterly report from those companies. But good question there, my friend. What's up, Liam? That's why behavioral economics has been such a game changer. It exposes our psychological biases, our animal spirits. We all have them. I know I have them. Made me make some very bad decisions over the course of my investing lifetime, but I've learned to tame them. And I work with a financial advisor right now who keeps me from doing silly things. But yeah, we have to understand the way our brains work, right? We are animals at heart. We're fearful, we're greedy, we're scared, we're hungry, we're promiscuous. Makes us make bad decisions sometimes. So you got to understand the way your brain works. If you want to be a long-term investor, do it right. So thank you for chiming in, and big thanks to Claudia Sahm for chiming on in, for coming back on the Investopedia Express. She worked inside the Fed. When you get your own rule named after you inside the Federal Reserve as a potential recession indicator, you know you're doing something right. So make sure you're following Claudia, her good work, especially her Substack. And a big shout out to Invesco QQQ. Thanks for partnering with us on this and for Recipe for Innovation. Had a great time at Future Proof interviewing Chef Tom Colicchio, and then again at Atlanta Food and Wine over the weekend, talking to our good friend Chef Kwame Onwachi and Chef Marcus Samuelson. Such an incredible program, Recipe for Innovation. Thanks for partnering with us. And will we ever be doing a meet again with EYL, with Earn Your Leisure? Don't break it. No, of course not. EYL's family. Can't wait to get back on Market Mondays. We're going to have them back on this show, but we love our good friends at Earn Your Leisure. Got a picture right there, me and Troy, me and Rashad up here on the wall. They are family to us. So make sure you're checking out Market Mondays on Monday nights with Earn Your Leisure. And thanks again for joining us. This podcast is live every Monday, the live podcast, the Investopedia Express, and on demand wherever you get your podcasts throughout the week. Thanks so much for joining us, and we'll talk again a little further on down the line.